Now speaking, David Lowenstein, Assistant Vice President, Investor Relations. Bill Nash, President and CEO of CarMax, opened the fiscal 2024 first quarter earnings conference call by introducing himself and other members of executive leadership. He also reminded listeners that all statements made during the call are forward-looking statements, based on current knowledge, expectations, and assumptions, and could differ materially from their expectations. He advised listeners to review the Form 8-K filed with the SEC earlier in the day and the annual report on Form 10-K for the fiscal year ended February 28, 2023 previously filed with the SEC for additional information. Lastly, he asked attendees to limit themselves to one question before getting back in line for follow-ups. Now speaking, Bill Nash, President and Chief Executive Officer. In the first quarter of FY24, CarMax's total sales were $7.7 billion, down 17% year-over-year due to lower retail and wholesale volume and prices. Retail unit sales declined 9.6% and used unit comps were down 11.4%, an improvement from last year's third and fourth quarters. Average selling price for retail units declined 5%. Wholesale unit sales declined 13.6%, also an improvement from last year. Average selling price for wholesale units declined 18%. CarMax purchased 343,000 vehicles in the quarter, 14% of which were online, with 54% being omni-sales. CarMax Auto Finance delivered income of $137 million, down from $204 million during the same period last year. Now speaking, Enrique Mayer Mora, Executive Vice President, Chief Financial Officer. In the first quarter, CarMax reported net earnings per diluted share of $1.44, down from $1.56 a year ago. Total gross profit was $817 million, down 7% from last year's first quarter, due to lower volume across retail and wholesale, partially offset by strong margin performance with both retail and wholesale per unit margins up slightly from last year's numbers. Other gross profit was $135 million, up 12% from last year's first quarter, driven by service, which delivered $4 million in margin, a $26 million improvement over last year. SG&A expenses for the first quarter were $560 million, down 15% from the prior year's quarter, excluding the benefit from the legal settlement. Excluding the benefit from the settlement, their SG&A leverage was 76%, roughly flat to last year's first quarter, as they continue to see the benefits of cost management efforts. To maintain flexibility, CarMax paused share buybacks in the first quarter and successfully renewed their $2 billion revolving lending facility post-quarter end with materially similar terms. Now speaking, John Daniels, Senior Vice President, CarMax Auto Finance Operations. During the first quarter, CarMax Auto Finance originated $2.3 billion in loans, resulting in a penetration rate of 42.7% net of 3-day payoffs, up from 39.3% during the same period last year. Despite credit tightening within the higher risk, higher APR portion of Tier 1 and reduced volume of Tier 3, the weighted average contract rate charged to new customers increased 20 basis points from Q4 and 200 basis points from the same period last year. Tier 2 penetration in the quarter was 20.4%, up from Q4 but still down from the historically high 25.2% seen in Q1 of FY23. Tier 3 penetration was 6.7%, down 40 basis points from last year. CAF approved approximately 95% of credit applications during the first quarter. CAF income for the quarter was $137 million, down from $204 million in the same period last year, primarily driven by increases in loss provision and interest expense. Total interest margin decreased to $258 million, down $40 million from the same period last year, with a corresponding margin to receivables rate of 6.1%. This rate is moderating its decline from previous quarters as a result of targeted rate increases on new originations to manage CAF penetration, finance margin, and sales conversion. The loan loss provision in Q1 resulted in an ending reserve balance of $535 million or 3.11% of ending receivables, compared to a reserve of $507 million last quarter. The existing Tier 1 portfolio continues to trend within the targeted 2% to 2.5% cumulative net credit loss range. During the first quarter, CarMax began broadly scaling yet another large lending partner within FBS, their finance-based shopping platform, providing millions of additional customized credit decisions in minutes to their online customers. Now speaking, Bill Nash, President and Chief Executive Officer. This quarter, the company has been focusing on projects that drive operating efficiencies and optimize experiences for associates and customers. To do so, they are leveraging Sky, a 24/7 virtual assistant. This enables customers to chat with the company efficiently while taking work out of the SEC system. The company is also rolling out Express Drop-Off, which allows customers to complete their transaction at one of their stores in under 30 minutes. Additionally, they are modernizing their auction platform to enhance the experience for dealers with integrated check-in, single sign-on, and proxy bidding capabilities. These steps have been taken to strengthen their competitive moat and position them well for the future as they emerge from the current environment. Oppenheimer & Company analyst Brian Nagel inquired, "Could you discuss the market share dynamics so far in the year and the drivers behind the improvement in used car sales?" Bill Nash replied, "Thank you for the question, Brian. We saw good sequential growth in our market share from January to April, while still maintaining strong margins. The used car market is still depressed, but depreciation was a headwind for certain areas of our business and good for the industry overall. We think it's a combination of factors that are unique to CarMax which have helped us manage our inventory and margin." Robert W. Baird & Company analyst Craig Kennison inquired, "What percentage of your buyers are making student loan payments and how could that impact demand when payments are required again?" Bill Nash replied, "Craig, I think from a sales perspective it's difficult to tell the impact of student loan debt on our customers as many are taking out consumer loans for extended periods. The majority of our retail customers are not in that position. I anticipate that our CAF business, which skews towards higher credit customers, is likely in a better position than other segments." John, do you have any additional thoughts? John Daniels replied, "I agree with Bill that our prime customers tend to be older. We evaluate total outstanding debt and other predictive factors when underwriting auto loans to inform our criteria for loan repayment." Stevens Incorporated analyst Daniel Imbro inquired, "Enrique, could you discuss the operational changes you made to reduce SG&A costs and the sustainability of that improvement? Also, could you quantify the one-time benefit from CAF receivables in the quarter?" Enrique Mayor-Mora replied, "In response to your question, non-CAF finance receivables are primarily loans issued to customers that we write off due to title processing issues or down payment obligations. We've seen favorability in that line due to improved staffing, DMV processing and a change in estimates. We also saw favorability related to headcount, which was offset by pressure from technology and strategic growth decisions made in prior quarters." William Blair & Company analyst Sharon Zakfia inquired, "How can Sky's AI technology help make SEX more efficient? Are there any step-up investments needed to optimize Sky further?" Bill Nash replied, "Great question, Sharon. We're bullish on AI in general and have been using OpenAI for some time now to enhance our associates' work by taking mundane tasks out of their hands. This quarter we've seen improvements with Sky, our virtual assistant which handles pre-qualification, transfers, and appointment setting. In the future, we plan to make it interact back and forth without needing a link and integrate it with I/O. Additionally, we've used AI to train our SEX consultants and for vehicle and customer reviews, freeing up our content team to work on more meaningful tasks. We are currently working on a knowledge proof of concept for our SEX that allows them access to state-specific information." Enrique Mayor-Mora replied, "Sky has been a key factor in helping us make our operating model more efficient. We've seen quarter-over-quarter cost improvements on a per retail unit basis, and even stronger progress when considering total units, use in wholesale, and gross margin dollars. Sky's had a meaningful impact on our model, contributing to the SG&A gains we're seeing." Bank of America Merrill Lynch analyst John Murphy inquired, "Could you quantify the dollar amount benefit your company received from the non-CAF uncollectible receivables?" Enrique Mayor-Mora replied, "I'd say the timing of events had minimal impact on our success. The majority of our success came from improved execution in stores, at the home office and in DMVs." Bank of America Merrill Lynch analyst John Murphy inquired, "What is your opinion on when same-store sales comps will inflect, and if they don't, what opportunity do you see to get more aggressive on SG&A costs?" Bill Nash replied, "John, looking back at 08-09, it took us roughly 7 to 8 months before our market share flattened and began to grow year over year. The COVID pandemic was a slightly different story and we saw results in 4 to 5 months. We remain focused on reducing SG&A regardless of the market share, taking measures such as optimizing Sky in stores, and looking for efficiency gains throughout all departments." Bank of America Merrill Lynch analyst John Murphy inquired, "What is the timeline for achieving the target of low 70%? Enrique Mayor-Mora replied, "This quarter was particularly strong, and we expect the rest of the year to continue to deliver our commitment for low single-digit gross profit. We plan to reach 70% gross profit in the near future, which is a marked improvement from our previous heavy investment phase." Bill Nash replied, "John, we anticipate that the macro conditions will continue to improve this year and we expect to reach our goal. If the macro conditions don't improve this year, we are confident that we will achieve our goal in the following year." North Coast research analyst John Healy inquired, "What changes have you made to the merchandise mix and age/mileage of vehicles you're selling today versus a few months ago? What is your multi-year outlook for supply, particularly in the late model category?" Bill Nash replied, "Thank you for the question, John. Affordability is still an issue as our average selling price is up from pre-normal times. 85% of this increase has been driven by vehicle prices, 15% by interest rates. We believe we've peaked on payment increases and are now around 130 monthly higher than pre-normal times. While our acquisition price was down nearly 50%, there's also been a mix shift towards more 8-plus-year-old vehicles, driving down the overall sales price but providing a tailwind for margins. Regarding inventory availability, new car sales are less than pre-normal times, but not as low as 08/09. We have better tools at our disposal now with high self-sufficiency, so we're not worried about inventory availability. Enrique Mayer-Mora replied, our inventory mix has shifted in the last quarter to include more vehicles priced below $20,000. Last year, this ratio was closer to 20%, and now it is over 25%. This shift allows us to provide our customers with more affordable options. Truist Securities analyst Scott Ciccarelli inquired, can you explain the exit comp rate for this quarter and the year-over-year comparison to the 95% credit approval rate? Did traffic decrease more than the comp results indicated? Bill Nash replied, I think about comps as pretty steady throughout the quarter, with no considerable difference from month to month. The quarter's performance was generally consistent across all months. Now I'll turn it over to John to take the other questions about credit. John Daniels replied, yeah, 95% approval rate for credit applications is remarkable in this environment with tightened lending. Our platform is robust and has enabled us to maintain this high rate. Truist Securities analyst Scott Ciccarelli inquired, how does the approval rate stay flat despite a tightening credit environment? Is it due to fewer applicants, but better qualified ones? John Daniels replied, sure. The platform's unique feature is its ability to provide credit even when a lender offers a higher interest rate or requires more money down. This is possible because of the multiple lenders and tiers within the platform, ensuring consumers can still consider purchasing a car. Our approval rate is not as strong due to the tighter controls in place. We have multiple lenders providing alternative solutions for our customers. Evercore IC analyst Michael Montani inquired, could you discuss comp trends quarter to date and the inventory levels year over year? Bill Nash replied, comp trends in Q1 have been similar to where we ended Q4. The team has done an outstanding job decreasing dollar inventory while increasing saleable vehicles. We're a bit lighter than usual in the traditional stores, but that is appropriate for this selling environment. Inventory levels are in good shape. Evercore IC analyst Michael Montani inquired, what investments do you anticipate to drive growth if the 7 to 9 month period persists? Bill Nash replied, I'm confident in our current position and outlook. We're staying vigilant on competitive activity and pricing, particularly for GPUs, while continuing to focus on improving efficiency. Our growth thus far has been encouraging, and I remain optimistic about the future. Wedbush Securities analyst Seth Basham inquired, can you provide insight into how much of the better performance in retail GPU was driven by market pricing dynamics versus internal factors? Bill Nash replied, our price elasticity test has not changed significantly, meaning we maintain strong margins and self-sufficiency. Additionally, our mix of older vehicles is more profitable. As I mentioned earlier, for the full year, our pricing has been adjusted to be between $2,200 and $2,300, similar to last year. We monitor macro factors and have picked up efficiencies that both support our bottom line and are passed on to the customer. We feel confident in our pricing. Wedbush Securities analyst Seth Basham inquired, can you hit $2 million unit sales for retail GPUs in the normal range of $2,100 to $2,200 for fiscal 26? Bill Nash replied, we remain committed to our long-term ranges and will update at the end of the year. We don't anticipate any changes for now. JP Morgan Chase & Company analyst Rajat Gupta inquired, can you please provide more detail on the $25 million year-over-year improvement in services efficiency? Is it primarily from reduced headcount or other areas? Enrique Mayer-Mora replied, thanks Rajat. We're pleased to report that our services department has seen a year-over-year increase of $26 million in profitability that we hadn't seen in a couple of years. This is due to cost coverage measures, increased labor and parts rates to counter inflationary pressures, and an improved focus on efficiency. We also believe the service department will show considerable improvement for the rest of the year. JP Morgan Chase & Company analyst Rajat Gupta inquired, could you talk about the year-over-year and sequential provisioning improvement, as well as any elements of recoveries? How should we think about provisions over the next couple of quarters? John Daniels replied, Rajat, the provisioning quarter-over-quarter was primarily driven by tightening of new originations. This resulted in lower loss rates and less money needed to be put towards receivables. Our recovery rate typically ranges between 40 to 60%. Year-over-year, we're down 12 to 13 points, but up sequentially. Recovery rate wasn't a major factor in the provisioning, unit carry was more influential. JP Morgan Chase & Company analyst Rajat Gupta inquired, could you provide more details on the 70% recovery you mentioned? John Daniels replied, recovery rate for the quarter was approximately 59 to 60%, significantly lower than the 73 to 74% from last year and 57% from last quarter. Needham & Company analyst Chris Pierce inquired, Bill, could you comment on the used car macro environment returning to 40 million units sooner than expected based on what you're seeing? Bill Nash replied, I don't think it's too early to make that call. We're seeing typical seasonal depreciation in the wholesale market, which is beneficial for consumers who are budget constrained. This could be a headwind for our wholesale business, but overall it's good for the industry and should help bring us closer to the pre-pandemic level of 40 million cars sold annually. Needham & Company analyst Chris Pierce inquired, is there potential for used GPU to exceed the estimated 2,200 to 2,300 range due to an increase in the retailing of older vehicles? Bill Nash replied, no, I wouldn't say there's more upside. As Enrique said, Q1 is typically a strong quarter for margins with less markdowns and higher inventory turns. We've seen this trend over the last year due to customers wanting older vehicles. We have the ability to stock our lots with whatever consumers are looking for, whether that be newer or older cars. If prices become more competitive on newer models, some may shift back in that direction. It's a great benefit of our business model that we can adapt to changing customer preferences. Morningstar analyst David Whiston inquired, what impact has the surge in demand for new electric vehicles had on the used vehicle market? Bill Nash replied, David, our EV sales currently make up about 1 to 2% of our total sales. Manufacturers are putting out more EVs and we want to be the largest used EV retailer as that market grows. We're already taking steps to make sure we can meet that demand when it comes. However, affordability is still a factor for most consumers. Morningstar analyst David Whiston inquired, can FBS customers' loan be securitized using CAFs? John Daniels replied, yes, absolutely. CAF is one of the 6 lenders currently participating on FBS, the online shopping tool. All lenders are able to offer CAF loans and they will be processed through our normal funding channels. Bill Nash replied, yes, David, our FBS product is a unique offering in the market. It includes CAF and long-standing lending partners which allow consumers to get the best rate on their monthly payments. John Daniels replied, 80% of applicants who use our online platform are successful in their credit applications. Bill Nash replied, yes, everyone can take advantage of our FBS experience. It all depends on the customer. Bill Nash replied, thank you for joining us in your questions. Our associates are our differentiator and we are proud of the values that we live each day. We recently published our 2023 Responsibility Report, which provides updates on our key initiatives, including climate-related efforts, and the tangible impact that we're having on our communities. We are confident that these initiatives will drive long-term sustainable value for all our shareholders. Thank you for your support today.